this session is also being recorded, and the recording and presentation slides will be shared with all participants. So with that, welcome, Jeff, and we look forward to seeing his presentation. Thank you.
Thank you. Thanks. Good morning, everybody. I am going to share my screen, I think, if I do this correctly. You should all be seeing the slide, the presentation now on the main page. Hey, Basil, is that correct?
I am not seeing it.
You are not seeing it, so I didn't share my screen correctly. Sweet. Let's go back here. How's that looking now?
We've got it now.
Okay, I just got to get the slideshow running. So just only seeing one. There we go. How's that? Well, good morning, everybody. Thanks for joining. It's a slightly interesting and different topic today than you might normally see from a CEU for an architectural company. What we're going to talk about today is how your work actually creates tax benefits for your clients. A lot of times there are opportunities for you to do some value add pricing in your benefits or proposals, or at a minimum, use the knowledge or at least information about these tax benefits as a way to differentiate your proposal from those who are maybe just straight price competitors. And I think, in our current economy, as things change, maybe a slightly different approach at times is going to be more beneficial to you as a provider of services. Just very quickly, Engineered Tax Services is a nationally based specialty tax engineering firm. And what we do is we do the kind of the technical work the IRS requires to document these credits and deductions. We work behind the scenes with you and your CPA to give you and your CPA all the information and forms that you need to file to capture these deductions. The same thing happens when we're working with one of your clients. We're not trying to replace anybody's CPA. We're not trying to change any of your current relationships, but look at us as a resource that you can call on as needed to take advantage of these opportunities and learn a little bit more about them. Some quick learning objectives today. We want to talk about how your private owners, meaning owners of private projects that you are working on, can benefit from that 179D energy efficient design deduction. Talk about how increased depreciation deductions will give them an opportunity to monetize some of the extra value of their new build projects and their renovation projects you design. And lastly, there's an asset disposition deduction that is available whenever you do a renovation. Certainly, you're taking stuff out of the building. You're removing landscaping, roofing, lighting, whatever. Those assets actually have a depreciable tax value to your clients, and we have a way that we can identify those values and help your clients capture them as a valid, legitimate deduction on their tax returns. The Energy Policy Act of 2005, that kind of tees us up for the 179D benefits that I mentioned earlier. Originally passed in 2005. It's been extended many times, still not permanent at this point, and Congress has used the excuse over the years of we don't have any revenue gains we can find to offset the cost of this deduction. So there are a package of items like 179D and 45L called tax extenders, and they get extended periodically at the whim of Congress. In 2016, the plan was for Congress to add nonprofit entities and tribal lands to the definition of what they consider to be a public entity, which would have helped architectural firms greatly. But at that time, if you recall, they were too busy arguing about the Obamacare website and how many hits there were and weren't on the website, and they just kind of forgot to do it. Last extension was in December of 2019. And to show you how good our Congress has been recently, the extension was retroactive to the beginning of 2018. So essentially, they opened up all the 2018, 19, and 2020 tax year projects to take advantage of this benefit. And it's certainly, as you know, it's an incentive for commercial buildings to be built and designed economically from an energy standpoint. So what's 179? It clearly qualifies. Any new construction is going to probably qualify for this. Any retrofit projects or renovation projects, whether they're historic or non-historic, they're going to qualify. Because as you know, 179 includes three pieces of that benefit for the lighting, the HVAC systems, and the building envelope. And each one of those has an associated 60 cents per square foot tax deduction assigned to it. And if you qualify for all three, obviously it's $1.80 a square foot. Focuses on commercial properties, multifamily properties, 4 stories and higher. If it's a lower height building like a garden apartment or a garden designed for a medical facility or rehab facility, there's an alternative benefit called 45L, which is a direct tax credit that applies in that little section of the market. The cost of the project has to exceed the benefit that you get. Oh, sorry, I just got a text from Zevi. So for example, you can't put a single bulb LED light in the middle of a 100,000 square foot warehouse and claim a $60,000 tax deduction, because the cost of the project has to exceed the tax benefit. In this case, ETS is an independent third party. The IRS loves checks and balances. They just love them. And in their eyes, in their mind, we are a check and balance to make sure nobody's taking liberties with the tax laws and tax rules here. So who qualifies? Property owners, obviously. They should be a tax-paying entity. That was my comment earlier about the nonprofit entities. A tenant in a building who funds their own improvements technically own all those assets, according to the IRS. It may not make sense to you because if you're going to put a new wall inside of a building and you're a tenant and you move out, the wall stays behind. But the IRS is concerned only with the fact that the wall was paid for by the tenant, so the tenant owns that deduction. Obviously, as you all know, designers of public buildings, architects, engineers, and contractors also qualify for this on an allocated basis. The next 3 slides are going to be a little bit hard to read, but they show up pretty well on the big screen. This is our guide that we provide our clients, and I'm certainly happy to send it to you if you want. Of the 3 components of the 179D benefit, obviously lighting, as you'll see on the right-hand side, there are different kilowatt hours per square foot guidelines based on the type of property that we're studying, whether it's a sports arena, a school or university, automobile dealership, what have you. There are different targets that have to be met. In the HVAC section, pretty straightforward. We want to see a 13.0 SEER or EER rating on the system. If you achieve that, you're going to qualify for that portion of the deduction. And the building envelope, we're looking at R values of 22 plus. Quite honestly, in the Northeast where we all are, the building codes are going to be such that you're probably going to exceed that without a problem on all of your projects. And I'll direct your attention to the upper right-hand portion of the screen. The comparative, the energy, the corporate baseline we use is ASHRAE 90.1, 2007. So you have 13 years more current technology that you're working with. And unless you do something crazy like way overlight a property or put in electric baseboard heating rather than regular heaters, you're going to qualify across the board for all 3 of those components. The second page of this item is it just talks about some of the peculiarities of each of the sections. Lighting, they like to see bi-level switching, motion detectors, things like that, dimmers. HVAC, we talked about SEER near rating, valves and economizers. And then the next page, we'll talk about building envelope, the R values, roof and wall R values. So it's a good handy guide to have. Like I said, shoot me an email or a text or something if you want it. Be happy to share it with you in a little bit better, more readable form than you see here today. The designer allocation for the public buildings, which I'm sure you're all familiar with, but you know, my OCD tells me I should cover this again just briefly. It was originally an Obama-Clinton initiative back in 2005. If you recall the economy and the world situation back then, the United States had some economic downturn issues. We had some maybe overly dependent on Mideast oil reserves and wanted to alleviate that dependency. And those were some of the motivating factors. The idea originally was that we were going to relight all of the federally leased space in the country, the millions of square feet of space they lease. And we're going to convert from T12s to LEDs. And that would give a lot of manufacturing jobs to make those LEDs, a lot of service jobs because there'd have to be somebody to install them and there'd have to be somebody to recycle the old bulbs. So it was a kind of a great all-around initiative. Didn't quite turn out that way early in its existence because of some of the quality issues from the foreign lighting. But as things are back on balance, and it's still a great economic incentive for all of us, and it really makes sense to consider that when you're doing any of your designs. If you look back into prior years, in other words, a 2018 to 2019 tax return project where the project was completed in that year, you will amend a prior year tax return to capture those benefits. If the organization is a C or an S Corp or an LLC, the benefits flow through to the partners. So they go down individually to partners. And it does carry forward up to 20 years. So if you can't use the entire benefit in a current tax year, it will carry forward for up to 20 years, which is a nice benefit to have and carry forward. The process certifying a private project is pretty much the same as doing one of your projects where you've had the benefit allocated to you from a public entity. We're going to look at square footage. We're going to look at the prints, obviously, the blueprints and the MEPs especially, to get a sense of the efficiency of the lighting, the HVAC, and the building envelope. We'll provide a benefit analysis to you where we say, we think there's X amount of benefit to you in this, in a tax deduction, if you do this study. We will also tell you up front what our guaranteed fee would be to do the study. And that gives you two of the most important pieces of information on doing an evaluation on the project. A, what's in it for me? B, what's it going to cost me? And then the third part of that decision is going to be C, obviously. You and your CPA are going to determine, or your client and his CPA are going to determine, how can I best utilize these benefits? Does it make sense to me in light of my current tax plans? So the end result is we're trying to get you a fully informed business decision that makes sense and is equitable to all parties. We will then, once we're engaged, we'll perform the analytics and the analysis. Probably a 4 to 6 week turnaround time from start to finish to complete our work. And then the tax return information we prepare for you and your CPA, the form 3115 is allowed for prior year projects. That's a change in the accounting method. Just technically, it's a form you file when you're amending a prior year's return. And again, amending is going to be required if you're looking back into prior tax years. The final report you're going to get in this project is going to be It'll include the certification letter that it's fully compliant and exceeds ASHRAE 90.1-2007. We'll look at design documents. We'll share all of our energy modeling results, which is important backup for you and the client, the site inspection report, and we'll share all of the tax codes and energy standards language. And these reports can actually be about 100 pages long at times, so they're pretty voluminous and pretty detailed. A couple of case studies. This first one is it's a 3-system study. Lights, HVAC, and building envelope. I think this was a new build actually. 220,000 square foot hotel in Florida, and their tax deduction because of the 179D benefits was $396,000, and that's going to equate to something in the area of $140,000 to $150,000 in net cash benefit. So imagine if you're working with a client on designing a new building, and because of your work and your design work, they're going to get $150,000 cash benefit on their next tax return. I think that's a compelling benefit to talk about and certainly share with your clients as you work with them. And the next case study is going to be this happened to be a high school. It was 198,000 square feet. Same thing, new build, 3-system study. In this case, we had a $360,000 tax deduction, which is probably worth at least $120,000 in net cash benefit to the building owner. Again, anytime your work can put an additional $120,000 cash in the pockets of your clients, in my mind, I think it's certainly worth mentioning to bring it to their attention. Again, take credit for it. I mean, obviously you didn't write the tax law, but because of the work you're doing, your client is going to see a benefit and realize that benefit. So again, the more you share with your client, the more knowledgeable, the more value added resource your client is going to consider you to be. Two other quick ones. In the upper left-hand corner, this is a Hilton hotel property, and it had almost a $600,000 tax deduction for lighting, almost a $750,000 tax deduction for the building envelope. Obviously, is a very large property. The total tax benefit of $1.3 million, probably worth $400,000 to the owner. Again, a significant cash return because of a great design from an architectural firm. The right-hand one at the top is an office building. If you see, the HVAC and lighting benefits are different than the building envelope, and that's because the building envelope affected the whole building. HVAC and lighting were only done on pieces of the building, and we can qualify each of those 3 systems based on only the individual square footage that is affected by HVAC or by lighting or by the envelope. So that's why you see different numbers there. Again, a $260,000 tax benefit, probably worth about $90,000, maybe $100,000 cash to the firm, to the client. And the last 2 examples at the bottom are just architectural firms who have used the allocated 179D benefit to their advantage. The first one has got over $1 million worth of benefit in the first 3 years. You can see 6, 7, and 8. The first 3 years that 179D was in effect. So each of those partners, the 3 partners, got a $300,000 worth of tax deductions allocated to their personal 1040s, and that was probably worth over $100,000 cash to each one of those individual partners. Obviously, they tend to return our calls a lot because they like us for helping them there. But again, I bring that up just to give you a sense of the size and scope and how compelling this benefit can really be, whether it's to an architect on a public project or a private owner. And I think many of you have probably used this 179D benefit for your public projects and have seen benefits come back to the firm. So it certainly makes sense to consider the same thing for your clients in their tax planning. Zevi, any questions or things we need to cover at this point?
No, I don't see any questions coming in yet. What would you just do?
I didn't see any either. So okay, we're good. We're good.
Yeah, Gary.
And feel free to raise questions throughout as thoughts kind of strike you. The second area I want to talk on is called cost segregation or component depreciation. This is something that's been around since the Reagan Tax Act in 1986. I happen to be the CFO at a bank that Basil mentioned when this came into play. I happened to be 2 years old at the time. I was kind of a child prodigy as a CFO at the age of 2. But what I liked about the Tax Act of 1986 was it was very specific, very precise. It told me exactly what I had to do. What I didn't like about it is it was very specific, very precise, and told me exactly what I had to do as a CFO. But nevertheless, the point there is a very well written piece of legislation, very well laid out. And one of the things they put forth in that legislation was that an owner of a property, and prior to that, if you owned a building or a rental property or whatever, you depreciated it over the life of the property, 39 years or 27 and a half years. And it was straight line depreciation only. There were no other options, no other alternatives. And as architects, you know that probably doesn't make a great deal of sense in the fact that the carpeting, for example, in a building is not going to last 39 years. You're lucky if it lasts 4 or 5. The parking lot in the Northeast with our rough winters, the parking lot in a building is not going to last 39 years. You're going to have to resurface it and patch it and maybe replace it. So the concept here that IRS and Treasury put forth was, let's say we can depreciate individual assets of the property on their own merits. In other words, you should be able to depreciate the carpeting on a different time period than you can depreciate the structure of the building. You should be able to depreciate the parking lot on a different timetable than you would, again, deduct the structure of the building. So it brought the idea of component depreciation into play. And what component depreciation does for your clients is it significantly increases their upfront cash flow, because if you think about it arithmetically, they'll have more depreciation deductions early in the life of the property as opposed to the same deduction year after year after year after year. That translates into a reduced tax liability. And again, anytime you reduce tax liabilities, you put more cash in the hands of your clients. The IRS and Treasury like cost segregation as a method of depreciation. It's the most precise, most accurate, and that's why they like it. And it also helps you optimize annual deductions for maintenance, repairs, and the write-off of assets. A little short video here. Hopefully you can all hear this okay. I'll turn my speaker up a little bit.
Next generation cost segregation method. Cost segregation tax set that is reduced success for years. Lowering tax liability by accelerating depreciation from assets like an office building through property identified component method as approved by the IRS. But then found and their tax like registration cost study looks at accelerate assets. for shorter depreciation. So, how what is the value quality to ensure the IRS findings on depreciation by most efficient, most successful for well-managed and tax are applied.
I like how the IRS guy is drawn as kind of shady looking with the baseball hat over his eyes and the sunglasses, but there was no political statement intended there. But it just, I think it's funny the way he shows up. So it gives you an idea at a high level what cost segregation does for your clients. Break the building down into its components. We depreciate each component on its own merits, and that's how we create additional cash flow benefit up front for the client. So who's a good candidate? Anybody who has a property with a building basis of say $300,000 or more is a good candidate. And when I say building basis, I'm talking about probably the AIA 703 document that that you're going to share, or the general contractor will share with the client, or that you use in putting together your construction budget. I'd like to see at least $150,000 in leasehold improvements if it's a renovation project, and then obviously we want to make sure they're paying federal tax and they're a for-profit entity. As I said before, new construction or existing properties qualify, whether it's a purchase, whether it's a rental property, whether it's just renovations. Those are all situations that you should consider or have your client consider, at least looking at the potential value or benefit of a cost segregation study. What kind of properties benefit most? This is kind of a nice slide because it shows you various types of properties, how much of the percentage of the asset value is typically related to what the IRS calls personal property and what's related to real property. And really, if you look at it, really real property, sorry about that. If you look at it from the standpoint of the fixed portions of the building, the walls, the foundation, the windows, the roof, the doors, the interior walls, those are all real hard property. The personal property is going to be things like accent lighting, parking lots, landscaping, carpeting, wall coverings, furniture and fixtures, things like that. So you get an idea that a resort, at least a third of the value of a resort kind of property is probably going to be personal property related. Restaurants, residential rentals, hotels, nursing homes, those are all very lucrative kind of properties. Even at the bottom of the list, certainly airport hangars, I don't have a disagreement with, because they tend to be relatively barren inside. They might have a small office and there's not a lot of stuff we can depreciate more quickly. Manufacturing and processing facilities, this chart I disagree with because I think they're a lot more significant than they show, because there's a lot of specialty wiring and lighting and HVAC systems in support of specific machinery and equipment in the manufacturing site. So I put manufacturing systems up a little bit higher than that. But again, you get a sense that there's a wide range of properties that are going to benefit from a cost segregation study. What kind of items get reclassified? You probably can look at this list and add 10 or 20 more items. But again, it's things like millwork, land improvements, decorative items, decorative lighting. In cases where we have, I had a client in Colorado recently, a big, not a resort hotel, but a hotel that had a big business center in it. And they put a generator on site to only light and keep the power consistent in the business center, because they wanted to make sure they didn't lose any of their business meetings or clients to the unpredictable Colorado weather. Because that is a specialty use item, it is a 5-year depreciable item and qualifies to be depreciated more quickly than if it was part of the HVAC system of the regular building. So little things like that. anything that is specialized service or has a specialized function within a building, something can be written off. You can see it again in the list. Window covering, security systems, video monitoring systems, security gates, those kind of things are all depreciable more quickly than the full life of the building. We talk about depreciation a lot, and we talk about something called bonus depreciation very frequently now because of the Trump Tax Act in 2018. What the Trump Tax Act did was he created a new category of what's called bonus depreciation. And what that says is any item with a depreciable class life of 20 years or less can be written off at 100% in the first tax year. Not a surprise that a real estate leader in the White House and leader of the administration would have a tax plan that has a lot of real estate benefits in it. But again, it's not our jobs to make the tax law. It's our jobs to follow them and take advantage of them as they apply in our situations. So the increase in allowing 100% bonus depreciation was a huge windfall for real estate owners. And son of a gun, you guys do a lot of work for real estate owners, a lot of designs for renovations and new buildings, and you're helping your clients capture these benefits. It's now available for both new and used qualifying property. Previously, before the Trump tax law, used property did not qualify for bonus depreciation, only brand new property. Now, any property that you buy is going to get bonus depreciation benefit. And as you see, I highlighted below, from the start of the Trump tax law on 9/27/17 through the end of 2022, there's going to be 100% bonus depreciation allowed, and it'll ratchet down 20% per year after that. And that was sort of a political compromise that had to be written into the bill to get it passed out of the House and Senate. Case studies. We talked about what cost segregation is, how it works, what the pieces are. What does it mean? What's in it for me? What does your client see in the way of benefit? We got about 4 or 5 different case studies here I want to run through with you. The first one is a $5 million multifamily property. It was a new property built in the Philadelphia suburbs last year. And this chart shows the blue line, if I can get my mouse there, this blue line is good old straight line depreciation. So that's $5 million divided by 27.5 years. There is another way to depreciate assets called the Modified Accelerated Cost Recovery System, or MACRS. And this red line is the MACRS depreciation if you elect that way to depreciate the asset. And then what was supposed to be a green line here is what the depreciation is on this property using the new bonus depreciation rules. So essentially what happens, the building owner goes from depreciating about $180,000 per year on a straight line basis to the first year, he or she can depreciate almost $1.6 million in the first tax year. And that's worth about $660,000 in net cash benefit through reduced tax liabilities. So essentially, what your work is doing and what the tax law allows your client to take advantage of is, in the first year, he's going to get enough of a deduction to pay for more than 10%, probably more like 12% of the cost of his building in the first year alone. Obviously, as you'll see, and you're probably noticing, those who are geometry and college math experts know that the area under this green line down to the blue line, that area equals the area of the difference where the green line falls below the blue line over the rest of the property. So that $1.6 million in depreciation you grab in the first year is going to be paid back a little bit year by year over time. clients say, well, I don't want to have that loss of depreciation in the future. But as you know, most buildings are going to go through some capital expenditure projects during their life of their building. Those CapEx, so-called CapEx projects, will add additional depreciation to the client and will help bring that green, what should be the green line, back up closer to that blue line. But the salient point here is the tax law says you can write off $1.5 million in this property in the first year, and you can create $600,000 plus $700,000 in net cash benefit. Second one is also a $5 million project. This is an office property, and I can't remember where it was. I think it might have been in Massachusetts, but nevertheless, it's a $5 million office property. In this case, I show you the same, the blue line, the red line, the green line. Yeah, I showed this just to say that an office property is only going to have about a $1.3 million write-off in the first year, not the $1.6 million write-off that the multifamily property had. And this poor person is only going to have a $540,000 cash flow benefit. Boo-hoo for him, right? And I, again, just not to be silly about it, I wanted to show this because it underscores the relative difference in types of properties and how they might perform on a cost segregation study and a bonus depreciation basis for your clients. Still, $540,000 net cash benefit, guess what? That's a win-win for your client. And remember, he or she is gathering or capturing that because of the work you did. So keep that in mind. This is a $600,000 renovation. In this case, the client is going to get probably about $250,000 tax deduction on the renovation work that you designed for his or her building. And that's going to be worth about $90,000 in cash to them. Again, if you can throw $90,000 in revenue and benefit into the mix in someone considering a renovation project, it kind of makes it a no-brainer. The renovation project now becomes a lot more manageable, a lot more tolerable, if you will, to your client in their eyes and in their mind. Here's another $100,000, just a slightly smaller improvement project. But in this case, the client was able to write off $75,000 in the first year, because most improvement projects, if you think about it, they're going to tend to be interior stuff, new carpeting, maybe upgrading the lighting, maybe redoing the landscaping, improving security systems throughout, what have you. So they're going to tend to have a higher percentage of deduction write-offs in the first year. But again, $100,000 cost, $30,000 first year net cash benefit to that person. Again, very compelling story. And my role, frankly, is a lot of times more educational than technical. A lot of times I'll tell people who ask me what I do for a living, I say I'm in the awareness business. And they look at me funny, which they tend to do anyway. And they say, well, what's that? And obviously what I'm doing is making you or your client aware of the benefits that are available to them in the tax law. And as I talked about earlier, I can tell you what's in it for you. I can tell you what the cost is. You and your CPA and his CPA need to determine whether or not that makes sense for them in context or light of their tax plans. But again, without that knowledge, your client may kind of walk around and walk through and do a project and not take advantage of something that's available to them. This just I threw in as another example of, this is a case where you have a really good client who might happen to be a friend and say, oh, I blew it, I didn't mention cost segregation to them in 2 or 3 years ago when they put the building in service. Well, the law allows us to study a property that's been in service. As you can see here, this example, since 2014, they use straight line depreciation, but in 2018 tax year, we did a cost segregation study for them, and there's a catch-up deduction, depreciation deduction that they qualify for In this case, they got about a $900,000 additional depreciation deduction in that tax year, and it was worth almost $400,000 in net cash benefit to them. Again, anytime I can do something for a client and put $400,000 in their pocket, they're going to be really happy. I've certainly talked a lot about cash flow dollar benefits. I know there's going to be a question. I know I always get the question about, well, how much does this cost? You know, it's great that you're saving my client $387,000. The cost for this particular study was probably about $7,500, and that's it, $7,500. So you get a really nice return. You can do the math, but it's a pretty significant return. $7,500 for $387 in return benefit. The increments and the ROIs on cost segregation studies are always going to be very, very significant if you follow the target guidelines I mentioned earlier. A slide I put in to sort of bring in the idea or the concept of stacking benefits. There are multiple layers and types of benefits out there. This happens to be a case study of a building our CEO purchased in St. Louis last year. Paid $1 million for the building. He put $10 million. He's putting $10 million into it, and he's going to wind up having $8.6 million worth of tax benefits or incentives. So he's putting $1 million into the building, $1.4 million out of pocket, and he's got an $11 million building for $2.4 million. And I'm not saying all of these credits or benefits are going to apply to every project, but what we specialize in is finding these additional benefits above and beyond cost segregation, above and beyond 179D, energy efficient design. There may be a cell tower income. We're doing a lot of work with 5G installations now. There may be solar tax credits. There could be brownfield grants. Just the point here is, don't just say I got one benefit, I'm good. Make sure you think about multiple benefits. And speaking of multiple benefits and benefit stacking, I want to talk to you for just a second or two about partial asset disposition, or PAD. Whenever you do a renovation project for a client, certainly part of that is going to be that you're going to take something out of the building. You're going to tear out an office, or you're going to pull up the carpeting, or maybe you're going to replace the roof. That creates an additional tax benefit opportunity for your client. So the disposition of, remember the term MACRS I used earlier, but disposition of property occurs when the ownership is transferred or when it's just permanently withdrawn from use, sold, exchanged, retired, etc. So when you put a new roof on a building, you're taking the old roof off. Your client should be aware that they can write off the net remaining depreciable basis, the economic value of that asset, because it was taken out of service. It was thrown away, if you will. We did a bunch of these studies back in 2014 of NFL stadiums because the tax law changed and created a technical opportunity. It's not important for this conversation, but in studying NFL stadiums, we found hundreds of millions of dollars of assets that they had taken out of service but hadn't written off in the normal life and operation of a sports arena. If you think about it, even M&T Stadium, which is pretty new, they're changing the concourses, the food vendors. They're redesigning the luxury boxes. They might be putting up new auxiliary scoreboards or TV monitors throughout the stadium. They're replacing the end zone turf. All of those are cases where they take an asset out of service. Remember, whenever you do that, and when you're thinking improvement projects, think this: you're taking an asset out of service, you're creating a benefit, a potential benefit for your client. A quick example here for you. This is an $80,000 lighting system that was 10 years old in a 60,000 square foot building. So what happens is you're going to depreciate $2,051 per year on a 39-year class life. 39 times 2,051 is going to give you the 80,000. The 2051 depreciation per year times 10 years means they've depreciated $20,500 of that asset. There's still $59,000 of unrealized, undepreciated economic value or benefit to that asset. So when you come in and do a retrofit of lighting for $60,000, or for a 60,000 square foot building, they've got a $36,000 tax deduction, 60,000 times 60 cents. So what happens in the metrics or the economics of this particular project, the abandonment deduction is worth $59,000. The energy deductions are worth $36,000. So what happens is you create a $95,000 tax benefit versus just a $36,000 tax benefit when you include the value of those abandoned, written off assets. So that goes back again to my comment about stacking benefits. When you do an improvement, make sure that you're capturing the depreciation benefit through cost segregation, but also don't forget about the abandonment benefit. Real quick, I'm sure you all know this on the benefits flow from any private projects that you've done and had benefit allocated to your firm. If the legal entity or your client is a C corporation, the benefit stays in the corporation, all this tax benefit. And C corps use this to preserve cash flows for acquisitions, contingencies. Maybe they want to put a new roof on their building, and it's a way for them to sort of stockpile cash with no tax impact. Because if you take the tax deduction and offset it with cash, as you probably know, a C corp is taxed at 21%. So for every $100,000 in tax deductions I can show a C corporation, they could put as much as $500,000 in cash aside. So it's an attractive planning benefit for S corps or for C corps. For S's and LLCs, as I said before, this is kind of a no-brainer. The benefits flow through the legal entity to the individual shareholders on a pro rata basis, and it benefits them personally. And that's fair, because if you think about the structure of an S or an LLC, the shareholders, the owners, are the ones who have to come up with cash if there's a shortfall. So they're gonna receive that benefit. One other quick point on the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act. Secretary Mnuchin put a provision in that says if you have a net operating loss in a given in a tax year in 19 or 20, you can carry that back 5 years and create refunds of prior taxes paid. This is a one-time special situation they put in place. And it doesn't make sense financially, but what it makes sense is, at that point, Secretary Mnuchin and the administration were looking for ways to get cash back in the pockets of people quickly. PPP loans, stimulus checks, this provision got put in place. And I mention it only because if your client, or even you, have enough benefits through cost seg or 179D or pad deductions or whatever, that it could put you into a paper loss or net operating loss position. You can now, you don't have to carry those forward and use them up later, carry them back and get an immediate tax deduction. And again, I highlighted, use that kind of thing to your advantage in bid discussions with your clients. If they say, well, I don't know, I don't need deductions, I'm in good shape. Keep in mind the fact that you have an opportunity to create a net operating loss, and they can carry it back and get immediate refunds. Last area, partnership options. How do you take advantage of this other than listening to this presentation 3 or 4 more times? Seriously, things to consider. Maybe you mentioned this in a written presentation where you're talking to a client, here's our proposal, and we've done this, this, and this. And by the way, this project will qualify you for a significant depreciation deduction. under the current tax laws. Please contact Jeff Kimmel. He's a great guy at Engineered Tax Services, for specific benefit information. You can put something as general or as generic, either in a written presentation or even in your conversations, for crying out loud. I mean, again, my goal here is to help you differentiate yourself as a value-added resource. We can prepare a specific benefits analysis for your clients. And the typical, it's a typical referral warm introduction. We lead the activity, we do the study, we bill the client, and we'll revenue share 10% of whatever fees we gathered from the client. Last but not least, I always feel like I want to mention the research and development tax credit to my architectural friends when I talk to them. Keep in mind that you will get a federal tax credit as a firm for every $100,000 in qualified expenses we can document for you. And I say, don't overlook this. And I say to you and your clients, don't overlook cost seg for them and so on, because the law says you have to file and pay taxes, but it doesn't require that you leave a tip. And for crying out loud, don't overpay your taxes from a lack of knowledge about taxes or about the tax laws and how they benefit for you. I'm gonna wrap up now. I think I got a minute or two left. Zevi, any questions? Anyone else have questions or thoughts they want to share at this point?
Yeah, there's some questions coming in. Basil, do you have access to the questions?
I do. There's a few questions in our chat box. Jeff, the first question is about recommendations on getting compliance letters from clients, especially public clients. I don't know if you can speak to that. Do you have any experience
compliance
with that?
letters, you mean allocating the public design benefit to the architectural firm? Yeah, if that's the question, my very good answer is yes, we have a form that's been accepted and used by the IRS that the public entity, it's a letter they execute in favor of the architectural firm to document and document the fact that they are assigning the tax benefits to that project to Basil's architectural firm, for example. And that's part of our service.
All right. I hope that answers the person's question.
And
If it's not, please reach out.
Yeah,
Please
email
reach out
me,
to
please.
Jeff.
Yeah.
The next question is about 179D. If the requirement for the tax credit is that it must be more expensive than the project renovation element, is there a threshold for the delta between the two?
No, actually there isn't. The credit, the law says the credit, I'm sorry, the 179D deduction cannot exceed the cost of the project. So if it's a total all-in cost, including labor and design and everything, is $100,000, you can't take more than $100,000 deduction on that project.
Okay. And the third question is, it is asking if the tax incentive will be renewed past December 31st, 2020.
Oh, there's one in every crowd, huh? How can I answer that? I already badmouthed Congress for dropping the ball in 2016. If the Democrats win, remember this was an Obama-Clinton initiative. It's like motherhood and apple pie. The Democrats will find a way to renew this. And if you think about it politically, they need some wins because in the eyes of the question of taxes, because Biden's going to raise tax rates. He's already come out and said that. He's going to tear up the Trump tax plan. He's already come out and said that. So this will be a nice way for them to say, hey, Mr. and Mrs. Taxpayer, Mr. and Mrs. Voter, we're giving you something back. If the current administration stays, it's going to get renewed because they're looking for ways to put stimulus dollars in taxpayers' hands. This is a great way to do it. And it's real estate oriented, and our administration is real estate oriented. in their thought process and their experience. So I think it's going to be renewed one way or the other. We just got to wait for Congress to get around and do it.
Okay. There are no more questions. I don't know if there's anything else that you'd like to bring up, Jeff.
Actually, yeah, a couple, when I've done this presentation before, I've had people have asked me, well, who should I show this to? I'm not saying show it to every client, every proposal you do, but maybe think about your best clients. Everybody has a client or two or three that are kind of their sweet spot. They do everything with you. You know, they love your firm, your business, how the work you do. So maybe show it to them. And again, I'm not advocating that you put your quality of work and designs in the backseat and promote Jeff Kimmel and ETS, but rather use me and ETS as a way to supplement and support the value add you deliver to your clients. And the other question I have a lot is, when's the best time to engage somebody in this? Certainly when you're doing the design and in the bid process, including information about the potential tax benefits is a win. But as you saw in the presentation, if you have a really good client you designed a building for last year, we can still come in and help them out. So there's no right answer one way or the other as to when the best time is. Again, I'll kind of share my screen one last time if I can. I don't know if I can or not. Oh yeah, there it is. My contact information is there. It'll be in the handouts if you need them. Reach out to me if you have any questions. Thank you so very much. Have an outstanding day. And Basil, Lynn, I'll turn it back over to you to conclude today's meeting.
Thank you, Jeff. Our next presentation will be November 17th, 2020 at 11:30 a.m. for just certifications. Just certifications are like a nutritional label or equity transparency within organizations. Our next practice management committee meeting will be October 20th at 8:30 a.m. We look forward to seeing everybody. Thank you.
Thanks. Have a great day, everybody. Thanks a lot for having me today, guys. Take care.